Hello and welcome everyone to the Capital Mind podcast. If you'd like to know more about us, visit capitalmind.in, and if you'd like to invest with us, do visit capitalmindwealth.com.
This podcast is for informational purposes only and should not be relied upon as the basis for investment decisions. Clients of Capital Mind may maintain positions in the securities discussed in this podcast.
Hi everyone, and welcome to a new episode of the Capital Mind podcast. In today's episode, we use Paytm and the Adani Group as more recent examples to discuss the concept of circuits in the market. We go into why they exist, what they're meant to achieve, how they work, what they actually achieve, what their shortcomings are, and finally, what are the alternatives or changes that can be made to help them function better. So if you're someone who's stuck with, say, Paytm stock right now that's riding up and down circuits every day, or have been one of these people in the past, do listen in to understand how you can understand circuits better and make them work for you. Deepak, with the RBI coming after Paytm the way it did a couple of weeks ago, this reminded me of a thing which I felt is relatively unique to India, although as you're going to point out, it's not as unique as I think it is, which is can I call them circuits on trading volumes? So the RBI comes out with terrible news and the stock falls, 10% or 20% a day. But then after some time, it can't fall that much anymore. And then it falls by less. And then it goes up. And as of today, the stock is basically operating in circuits. It's either an up circuit or a down circuit in Paytm's case. And this reminded me of two other experiences from fairly recently. One was just in the last 1 year. The Adani Group stocks have both been, I guess when that report came out in Jan, they were down circuit for forever. And then once they were proven innocent or something, then they were up circuit for a fairly long time. Maybe not as long because they had recovered a bit. And then going back a few more years, Coffee Day, if you remember, after the unfortunate death of their promoter, the stock was just lower circuit for a very, very long time till it fell to something like 10% of what it was. So based on this, I just wanted to ask you, where has this idea come from? And are we the only people who do this? So maybe we could start with that and then we'll take this forward.
Awesome, Shrey. I think it's a good topic because, circuits are an interesting point. It's not just at a stock level. There's been circuits at index levels. And this kind of a circuit got introduced in 1987, I think, in stocks. There were always limits in commodities. So if you traded commodities, there was a limit up, limit down kind of a price, where you couldn't the security was always supposed, the commodity was always supposed to trade in that range. In 1987, the entire market fell 25% in a single day. That was October, Black Monday 1987. The problem at that point was a very clinical one. In the US, you have market makers. Market makers are told that you have to put a bid and ask for a stock. So a market maker typically owns a lot of stock, right? So the stock is down 40%. You will end up with that stock taking down your overall valuation because now you've taken a loss because you bought it at a price that's 40% higher. Now it's 40% lower. You've lost the money.
You being the market maker.
So it means that it's possible that in a steep fall across all sorts of stocks, you're actually insolvent because you probably borrowed to buy those stocks and run your market making operation in the first place, and therefore you may not have enough capital left to run the business. So in a way, you need a little bit of time before you even figure out that you're insolvent because price is changing so fast in the first place. So what they do is they halt the stock. They say there's a circuit limit on the index itself. They will halt the trading of entirely so that market makers kind of figure out where they are. And then they can raise their hands and say we're insolvent and not being market makers anymore, or they continue to be. And that is one of the reasons why it was very important to do it. The second is obviously to prevent panics because one selling can result in another selling and another selling and so on. So they wanted to say, okay, you can't sell more than this much at this point. Now, earlier, when market makers were introduced, 1950s and 60s, you saw a lot of things called fast markets. This was interesting. I found this in a book somewhere that actually talked about what it meant. There was this tape, and the tape was...
the infamous ticker tapes.
Yeah, the ticker tape. So the ticker tape would actually keep rolling, right? So it would have a stock price, and bid and they ask for it and the price at which last traded and so on. So typically, if a trade happens, the minute the trade would happen on the floor, it would get reported to somebody, that somebody would put it on some machine. The ticker tape would then be, it would be like a telex kind of a thing that would kind of run across the globe to people who were not on the floor. They could get to see the prices and so on. But if you had a fast market, that means a lot of people selling or buying, trades were happening. And then by the time they would go and announce it to the person who was supposed to update the ticker, and the person actually updated it, because he had so many things to update. He was using slips to update the prices. The problem then was people couldn't know what any stock was trading at, because it could be that price could be like 10 minutes ago, because what's coming onto the ticker right now was actually traded 10 minutes ago, because so many data updates are there that the actual ticker takes time to actually catch up with the real price. So at that time, the market makers would say, this is a fast market. We are therefore not going to provide bids and asks at the same kind of spread. So it let the spreads widen quite a bit. And then because they couldn't figure out what the price should be and evaluate their position. So this was a different problem, because you had a fast market. They would simply stop providing the trades. So it was not really a market maker curb. It was not a trading curb itself, like what market makers face now in circuitish kind of market. But in 1987, they flipped to an actual trading curve where they said the entire market is going to stop trading if it falls more than 20%. That was the US in that concept.
Well, so clearly this stuff exists elsewhere. Then let me just bring this back to India then. So when did we start? I guess you were there to witness this.
I was, but I was not actually in the markets at the time. I was probably trying to figure my way out. It was in 2001. So roughly after, maybe before 9/11, but after the 2000 wala stock breakdown and all that stuff, it's after that is when the SEBI came out with a guideline that said stock exchanges must have circuit breakers for index-wide falls, which meant the Nifty index and the Sensex index, which were the two indexes here. You had individual stocks which had circuits anyway. They could only operate in like a 20% range. We'll come to that. But an index halt was very different. We don't have market makers in India in meaningful way. So if you want to create a trading halt mechanism, the idea was not to solve the market maker problem, but it was primarily to solve the panic problem. The panic problem was that, we need to give people time to regroup if a big move happens. So the idea was, if you find panic in the market, try to solve that panic by saying, let's halt trading, let's regroup, and let's come back. Right? So that is a form of a trading curve. There was another trading halt for a completely different reason. It was called the sun outage. This is people from the old ages will remember this, because VSATs were used for exchanges to broker communication. The issue with VSATs was they had to use satellites. And satellites would get all wonky when there were certain areas, certain parts of the year when the sun spots and some kind of electromagnetic activity would happen that would ruin the satellite's ability to communicate. So for about 45 minutes in the middle of a day, they would halt trading. That means between 11:30 and 12:15 roughly, or 12:10, 40 minutes, you would have absolutely no trading. Not because there's something wrong with the market or something like that. It's just that you have a sun outage. It's called a sun outage, and you could go have coffee and come back, literally something like that in the middle of the day, as if the market's taking a siesta. And it was the strangest thing in the world, but it was not a trading curve because of anything else. That was completely unrelated. But market-wide circuit breakers started in 2001. And by the way, the sun outage went out only after NSE and BSE both made it mandatory to have physical lines rather than using satellites. Otherwise, for the longest time, I think 2009, 2010 or something like that is when the sun outage actually was removed. It was only for 2 months of the year. So it was a very strange thing that used to happen.
Well, luckily those are days of the past. So what are the current rules regarding all these circuits and stuff like that?
So I think you look at different layers, right? So you have a set of filters on stocks. That means individual stocks, and on the index itself. So if you look at the index itself, it's different. So let me first go to let me start with the index maybe. The index is like the Nifty index. If the Nifty index hits 10% on either direction, trading gets halted for an hour. Then after it opens, if it hits another 5% on the same direction, that means if 10% became 15% from yesterday's close, you get a halt again for 2 hours this time. And then there's some rules about 11, whether this first trading halt is before 11 a.m., before 1 p.m. and things like that. And then at some point, if it hits 20%, that means after the second halt, if it opens up and it does 20% in the same direction, you end up with a complete trading halt for the entire day, regardless of when it happens. So this is the index level, but at stock levels things change, right? So stock levels have let's say there are two kinds of stocks which have futures and options on them, so derivative based stocks, which is about 200 stocks, 220 stocks, and stocks which have no F&O on them. Stocks which have F&O, the futures and options themselves have no price halts completely. What happens is there's no circuit. The stocks can actually fall 80-90% in a day. There is no issues with that, because you have the mechanism to stem a panic by going short on that stock on the same day. So what happens is there's only a temporary halt. That temporary halt sometimes happens when, let's say, an option moves too much. Option moves 20%. They might temporarily halt it for 5 minutes or 10 minutes, for, things like that. A stock itself moves quite a bit. They might halt it temporarily just to be able to figure out if they have to open new strikes and all that stuff. The idea over here is that small period halt is to curb small levels of panic, and then things change dramatically over a period of time. Now, these option kind of circuits used to exist in the past, but they were removed because of some strange reason. What happened was that, the smaller options which are only trading at say 1 rupee, very close to expiry. If the stock moves in the last half an hour, this 1 rupee can quickly become 2 rupees just to meet the intrinsic value. But you can't move to 2 rupees because you have a 10% or 20% circuit. So that became a problem for some of the options. So some of the options now, they don't have any circuits at all, which actually results in a lot of grief for a lot of people who play these options games, right? So there are people who sell options and then put buy orders at a price which they think is double or roughly double their entry price. The problem is these options are liquid. If everybody sits on the buy side and there's no circuit, then there's nobody on the sell side. So if you put an order to say, listen, buy at market if the price crosses 200 rupees or 5 rupees, let's say, you might think that, okay, if I put a market order at 5 rupees maximum, I'll pay 6 rupees. But you might pay 100 rupees because a lot of people will place the same kind of an order. The circuit limit actually created a protection for it, but they didn't want it specifically for options because of these complex derivative issues. But this derivative itself, the stocks itself don't have any kind of halts or pauses. The idea being the companies like Satyam, for instance, companies like Gitanjali Gems, they fell 80, 70, 60, 40, 50% on one day. And that was only possible with F&O stocks, because a stock itself, which does not have futures and options on it, has a peculiar set of circuits. Every stock that does not have a future, and by the way, LIC, a company like LIC, even though it's one of the largest stocks in India, 6 lakh crores in market cap, does not have futures and options on it. So every day filters, circuits on LIC apply. This is 20% on each direction every day. The first day that it hits a circuit, the next day, the circuit is again 20%. But if it hits the circuit again on the second day, then the circuits are reduced to 10%.
From day 3.
From day 3. So day 3 and day 4 circuits are 10%, but it has to keep hitting it. If it keeps hitting the circuit, that means if it stops hitting the circuit, your count starts again after some couple of days. So your day 4 of hitting circuits, if the day 5 is at 5%, and then it continues at 5% forever, or not forever, but for a reasonable amount of time. The other thing that happens is when you have a new listing in certain cases, new IPO listing in certain cases, apart from the day of the IPO, the subsequent 2 weeks are 5% circuits on each direction. That's because everybody knows that the first day of a IPO can be super volatile. But they found that the second, third day was also super volatile. So they said, okay, listen, let's not make them 20% circuit stocks. They make them only 5%. So this 5% circuit is the matter of, it's a formula that kind of do this. Now there's another layer of circuits in other stocks called ASM and GSM stocks. These are additional surveillance mechanism, and I forget what G stands for. But it's both a surveillance mechanism, stocks which have moved a lot behave peculiarly, have very low volume, they go into this ASM, GSM kind of thing. Some of the restrictions there are as bad as 2%. They can only move 2% up or down. That's, I know, very restrictive, but the idea is many of them have come into that kind of a surveillance mechanism only because they move too much. So when they stop moving in circuits, even in that range, is when NSE or BSE will take it out of the GSM and ASM framework. Therefore, it will kind of this thing. So there's other restrictions and maybe other curbs also, like for instance, you can buy some of these stocks only on Mondays of the week. So first trading day of the week only, which sounds a little strange, but that's what it is.
I think I get it. I'm just trying to summarize. So if you're an F&O stock, you other than it just slowing you down with temporary trading halts, you can pretty much, in theory, fall 90% today, with Satyam being the example of this one, if I'm not mistaken. If you're not that, you have this thing where it's 20% in either direction for the first couple of days. Then if you keep hitting it, then it's 10% in either direction, and then falls to 5%. And then, God forbid, who knows what happens after that. When I'm now thinking of then global examples, I remember when we were just prepping for this, you talked about one anecdote with Luckin Coffee, or when there's a rumor of someone's buying another company, which would then require things that other countries also. Well, let's just talk about the US. The US has different frameworks on how to handle it. So maybe you could think through these examples, talk us through it. M&A or that Luckin fraud in a company example.
Yeah, no, that's actually quite interesting, because what these are actually company-specific news. In the US, what they do is when there's a news, let's say there's a merger. I mean, Microsoft is buying some other listed company.
Well, Yahoo happened at one point. Claimed to buy Yahoo.
So the problem is, while this news becomes public, the news of the actual price at which this buy and all happens may take some time for them to formulate a press release. So what they do is they first do a trading halt, saying we are waiting news. So you cannot buy or sell the stock. By this time, rumors have gone crazy. So therefore, the market is probably pricing in a lot of things, but nobody's allowed to make any trades in the stock. Then they introduce the pricing curbs, and then they give about half an hour for the company to actually issue a press release. Once that is done, the stock is opened again. And this time, it may open 100%, 200% up. So let's say a company bought another company at 2x its price. So the stock price should technically go up 2x, because if you bought that stock at that point, you could then tender it for the sale and get your 100% up. This is one layer. But what if, like in Luckin Coffee, which was a coffee company in China apparently, which was listed in the US, and somebody figured out that they are not even a coffee company in China. Because
some massive fraud.
So,
I hope the company example is correct.
Yes. And then what happened at that point was the stock was halted, and then when it opened 90% below. So literally 1 minute you had $100. The next minute after half an hour,
you had sub 10.
You have sub 10. So you probably still have sub 10. But the point was, you weren't allowed to sell anywhere between 100 and 10, right? So if you actually end up with a point where your quantum leaps happen, not continuous leaps, this gives you another concept. The reason why I'm saying this is because we usually think that, this stock is overvalued. I can get out at any point. Because even if it falls 40%, I'll get out at 20%. The answer is because of circuits you may not be able to. Because in India, on the down circuit, the concept of a down circuit is that you have no buyers. They're only sellers. Buyers and no sellers is an up circuit. Sellers and no buyers is a down circuit. That means if you're a seller, there's no buyer. You're not getting to sell the stock until it comes out of the circuit. That means until the buyer turns up. And it could be days and months before you do that, right? So essentially, in India, it's a different concept. The concept of a circuit isn't a trading halt, because trading can still happen at the circuit price. It's just that the stock will trade only at that limit.
I would like to wonder then, maybe leaving the US examples you've said, but coming back to India, what would happen in case if the circuits weren't there? That's what makes me interested.
Oh yeah, that's, so for instance, the ways the circuit works is, let's say that a competitor comes and buys a company for 2x. Instantly the stock should go up 2x, right? Because of circuits, you end up with this price catch up happening over a period of X number of days. So I should do 20% first, then another 20%. So you're doing now 144%. At 144%, you grow 10% a day for the next 2 days. So 144 becomes 155 and 56 and all that stuff. So by the time you get to 180%, it's probably already 7 days. Then you get 5% a day for the next X number of days. So probably 15 days before it actually goes double in a circuit stock. On the downside as well, you can't exit a stock if you find that this is really bad news and everybody knows this bad news, and you put your stock order, like you talked about, say, a Paytm at some point, or talk about Gitanjali Gems. So there are different companies that,
or a coffee day, which kept falling.
Kept falling. So you try to put your order for the coffee day to sell, you would not be able to sell it because so many people wanted to sell it alongside with you that the chances of you being able to sell it were zero. The difference between that and say a Paytm and Adani Group was at some point you got buyers. Although the circuits were there, you actually place your order and kind of wait. In Coffee Day, there were actually no buyers for a really long time. So you would see no volume in the stock. A lot of sellers, no buyers, and almost no volume in the stock on a daily basis. So that concept of, one part of this to the other is this thing. Now, if circuits weren't there, the prices could have moved much faster. These prices might have come close to zero at that point. But there's an interesting problem with circuits. Because circuits exist, you, as a fund structure, suddenly life becomes very complicated. Like, let's give you an example. We're a PMS, okay? So we own a stock. Let's say we report the value of your portfolio is 1 crore.
Not in a PMS, is a managed account. No? So maybe think of it as an AF. In the AF,
yeah. So in a PF, the reason I'm saying this is because somebody else is managing the money for you. And then they're saying, listen, I own so much of your shares. Now, I'm telling you the value of your portfolio is, say, 100 crore or 1 crore.
Yeah.
But 20% of that 1 crore is sitting in one stock, which is a micro cap. Something goes wrong, building catches fire, something, and then everybody wants to sell this stock. So this stock is now going down at a lower circuit on a daily basis. What is the value of your portfolio? It's not 1 crore. You don't know what it is. It is somewhere between 80 lakhs and 1 crore because that 20% position either goes down all the way to zero, or it stops at 80. It stops at half price, or it stops at 75%, but you don't know what it is. This complexity becomes even more weird in mutual funds, like you just said. In mutual funds, everybody knows that a mutual fund owns a certain stock, let us say. So they look at the stock and say, well, you know what? Let's say there's a mutual fund that has one stock which is, 9% or of the stock of the portfolio. This is a really bad stock to have owned. But it's a 100 crore portfolio. Remember, mutual funds have limits which are roughly, I think, 10% per stock. You cannot have more than 10% in a single stock.
I think AF has a similar one.
AF also now has a similar one. So the idea would be now that people know your portfolio. They know that you own the stock. They start selling that stock and hitting lower circuit. Now, everybody knows that, listen, this guy is telling me the value of this stock is 9 crores. But obviously it's not because it's sitting on lower circuit now. 9 crores already become 8.1. So people put redemption orders on your mutual fund. The redemption orders have to be satisfied. You got 100 crores in assets. You can't sell this one stock. Let's call it ABC. You can't sell ABC, but you can sell everything else. So you sell everything else. You redeem 30 crores and give it back to your investors. Now you have 70 crores remaining in the fund. This one stock is 8.1 crores because from 9 crores it fell only 10% to 8.1. Your issue now is at 8.1 on a 70 crore mutual fund, this stock is worth 12% or 11%, or a little bit more than 11%. This is a violation. SEBI treats violations very harshly. So you have to go to SEBI and say, I'm sorry, I tried to sell it or I can't. And then you have to go to your trustees. Your trustees have to say, okay, we'll document this, and put this on this thing. This was so bad at one point. There was a famous PMS manager, and I won't name the PMS manager, but luckily in a PMS, you're only managing your own customers' accounts, right? So he said, listen, this stock is in your account. I'll transfer you the stock to your own personal demat account, but I can't redeem it. I can't sell it because I have these stocks. They are going down every day. If we try to sell them, the price will fall even more. Let me give the stock to you instead. If you want to really take out your money, and instead do this. So that, I think, has this problem. You have untrustworthy prices, untrustworthy NAVs because there are circuits, and in the end, this whole concept has also created some really interesting stories in the markets.
I'd love to hear them.
So, I mean, we can keep on going about...
Let's do three.
Let's do three. Let's do the top three. Okay. So, number one, I think would be this stock called Castex India.
Never heard of it.
Yeah, good thing you haven't, because I don't think beyond this podcast people would want to hear about it. But there's a group called Amtech Group. They owned Amtech Auto, and there was Amtech India. Company was called Auto Ancillary Company and so on. They had a bunch of what are called foreign currency convertible bonds, FCCBs. FCCBs were an instrument used very popularly in India. The idea was that you didn't raise equity, you raised debt. This debt would come into you as a foreign currency convertible bond. The idea being that, listen, I would say, Shrey, why don't you give me, say, $100 million? If my stock price is above, I don't know, $70 rupees per share, you will have the ability to convert it to shares. It's at your wish, right? And if it's below 70 rupees a share, then I will return you your money after 5 years. So it's a 5-year term for an FCCB. At the end of 5 years, if my stock price is above 70, obviously it makes sense for you to convert it. Otherwise, I'll return the money with the interest. Now, what would happen then for most companies who did FCCBs? The stock price would go up, and then people were very happy, they would convert it. So what would happen is debt would convert to equity. In this Castex India case, there were FCCB bonds, but the stock price had collapsed. And one of the covenants they had, and because these covenants can be very different for every FCCB issue, they had a covenant that said if the price is above some 192 rupees per share, we're guaranteed to convert them. You have to convert them. You cannot ask for your money back. You can't. It's a bond that's now effectively has to be converted to equity after a certain period of time. The problem was the stock was at like 50 or 60 rupees at the time. And it was coming close to the point where it was reaching maturity. So if the stock price was less than 192, they would ask for their money back. And these guys, the reason the stock was 50, 60, they didn't have any money. So miraculously, something happened. Now, I won't say who is responsible for it. I don't know the answer to that. But miraculously, suddenly the stock price started to go up. Because you know the formula, 20% 2 days, 10% every day, then 10% 2 days, and then 5% every day. It went up from that 50-60 rupee price time all the way to 340 something rupees, 43 rupees per share. Every day there would be a 5% circuit. If you're able to get your order in somehow and get some shares, you are making this 5% a day roller coaster thing all the way. So you sound almost like, dude, this will never stop. Because for it to go that much, it took a while. And exactly at 343, it switches, it starts falling, and it falls again in circuits all the way down to 30 over a long period of time.
This sounds like a miraculous coincidence.
It's completely coincidental. Of course, it's completely coincidental. But what it turns out was this FCCB conversion price of 192 was apparently the average of 30 days.
Miraculous.
And those average of 30 days was the stock going up to 343 and falling down all the way back to 30. The average price in those respective whatever period that they had to get it done was a little bit above 192. So they could calculate, whoever did this, or if somebody did this,
Divine forces.
The divine forces calculated that it would fall, and when it did the 5% every day, you could run it on a calculator and said it needed to go to exactly 343 and then start falling every day for the 30-day price to reach exactly above 192. It was quite remarkable because after that, of course, the company kind of went bust and all that, and that was there. But guess what happens when you have a share that's falling, but at the same time, there are a bunch of people who own FCCBs who have converted now, forcibly been forced to convert their exposure to shares. They convert their exposure to shares. What do they do with them? They'll sell them. So instead of the stock falling only to maybe 160, it fell all the way to 30 because there was just no buyer all the way. And it's only at 30 that the circuit opened now. If it was a really small portion of your portfolio, that was one thing, but it was just painful to watch as we kind of moved it all the way down.
So that was story number one.
That was, yeah, it went to bankruptcy. Let's look at a different story. It's a completely wacky story. And this is a story about Pakistan. At some point in 2008, I think, they decided that stock markets are causing a lot of people a lot of angst and agony. And what is the concept? Oh, you know what? People are throwing stones at the stock exchange because they're losing money in the stock market. Stocks cannot be allowed to go down. So they put a market-wide rule that said, no stock in the top 50 or 40 of the Karachi Stock Exchange, whatever, is allowed to trade at any point before its previous day's close. That means that if it was 100 rupees, it cannot trade at 99.99 also. It has to only trade above that. Guess what happened? What they thought was the floor and the prices could not go below that meant that the prices actually could not go above that either. Everybody either wanted to sell or buy at the price. Every day. There was no increment, no uptick in the Karachi Stock Exchange for 45 days. And then they suddenly realized this is completely stupid because A, nobody can trade because there's not enough volume for anybody to trade in the first place. And if you don't let the prices go down, if you can't fire people, you're not going to hire people. So if you're not going to allow a stock to go down, you know what? It's not going to go up either. So they took off the curbs. The whole stock market fell 40% in 2 or 3 days. And then it rose, and I think in the next 365 days, it was the best performing stock exchange in the world in comparison with everybody else. So it's a very interesting story because trading curbs sometimes just don't work, and especially for utopian reasons like stocks should not go down.
Well, I mean, here the lesson seems to be allowing people to panic created the world's best stock market for a year. So.
Well, interesting. Yes, I think that's a great point because that's the exact thing that you should focus on. In India, you have these limits, and I'll go to the third example. So we have India, we have Nifty. There are 4 specific instances, 4 years, which are peculiar to India. One is 2004, one is 2007, 2008, and 2009. And then, of course, the COVID year of 2020. So these periods are the exact years when the Nifty hit circuits. In 2004, there was a very interesting point where, people thought the Vajpayee government would get re-elected. But guess who came? It was the Congress government, but it had to take the support from the left. And the left said, basically, all you capitalists are evil. And therefore, we're going to kill everything. And the market went down 10% limit the next day. It kind of had already started to fall because people were worried about this kind of outcome. But after that, it rose, after that point. However, it never saw a fall like that again. That means that low point of that time has even now not been reached. 2007, in October, there was an announcement by the RBI on one evening that said FIIs who come in through P-notes, which were a concept called participatory notes, will have to reveal who they are. This was considered to be a big bad thing because nobody wanted to reveal who they were. So they announced this, and then the next day the market opened circuit down. This is like at a bull run. The market's gone up like 50% in the year already, and suddenly it goes circuit down. Then the RBI comes on TV and says, listen, no. We said they have to reveal themselves, but we're going to give them 5 years to do so. So I said, okay, it's 5 years later. And of course, now that rule has actually come into existence and nothing major has happened. However, it means that they meant that the stock market quickly recovered after this statement, and then things got kind of better from there. And that month itself was positive. So if you look at the chart, you can't even figure out when that lower circuit happened. Cut to 3 months later, Bear Stearns goes down in the US, and I think it was JP Morgan or one of these guys, I forget who it was. There was planned to buy it out.
JP Morgan for $2 a share or
something. For $2 and then made it $10 a share and all that. So while this crisis was happening, India had a massively large IPO called the Reliance Power IPO, and that took away a lot of liquidity from the market because your money was locked in for 2 weeks at the time. On the 22nd of January, the market hit a lower circuit. It went from 6,300 and eventually landed at 4,800 before it recovered. So it was like a huge jump in 2 or 3 days. This was so bad that, it basically ruined a lot of people's lives. I know this because I was moving to Bombay on the day. I had packed my bags and my entire luggage into a car. And
good omens for that move.
Yes. And I had actually shorted the market. So
okay.
Because it was a very interesting time to be doing that. This actually...
Well, 3 lower circuits in a row.
3 lower circuits in a row. And you think the circuits are only for lower circuits. then the market will surprise you on the upside again, because in 2009, there's another election, and this time the left is not there in power. Everybody was so excited that the next day when the stock market opened, it first opened 10% up. Then it was trading halt for an hour. Then it opens up, goes up 15%. So it was 3,600, ended at 4,200 on that day. It was a 20% jump on that one single day, 4,300, something like that. So basically, the market move was so strong and so heavy that nobody had seen this kind of an upcircuit before. And this is the first time that you had a complete trading halt for the entire day. That means a full 20% move and no more trading for that day. Massive jump. And the next move was COVID. I think COVID is when you had one of those days which hit when the markets hit a circuit. On the downside, it was 10% or so. So you have, you have interesting stocks though, that like we've talked about, say GTL, Gitanjali Gems, GTL Infra. These were all, some of them had frauds in it. Some of them had other reasons why the stocks went down. Satyam went down 90%. It was a fraud by the promoter. And then the company eventually got taken over and now is merged with Tech Mahindra. Yes Bank. There was an issue which on a particular day, the promoter was told that he cannot be re-elected as the CEO of the bank by the RBI, and the stock tanks 40% on that one day. Following it, a stock called Indiabulls Housing Finance and a stock called Dewan Housing Finance, DHFL. Both of them fall 25-30% on the same day. Another stock called Infibeam, that also fell about 30%. So it was like a crisis thing because cascaded one after the other and so on. Many of these are just margin calls. But these kind of deep falls have happened in F&O stocks. And then circuit stocks exist all the time. So for instance, you have a bunch of Adani stocks, Adani Green and so on, that I think they live on circuits almost 50% of the time. So every time you look at it, you're like, either there's no buyers or there's no sellers. So, we've had very interesting series of stories there.
Okay, so then I'd like to end with this. If circuits come with all these problems and all these weird experiences, what is a better way to manage circuits? And there is a logic behind them, right? As you've said, to allow information to disseminate, to allow panics to taper, or to unbridled enthusiasm to sort of cool off. So what do you think is a better way to deal with these problems?
Yeah, I think there are two ways you can deal with it. First of all, don't get these circuit prices lower and lower. At some point, stop them. So more than 3 days of a circuit, either you keep the same circuit price. That's option number one. This allows something to change. But one way to deal with it is to say, after 3 days of circuits, the fourth day, you should have a completely open day, which means let the price fall to whatever it has to fall. So if it's fallen 20, 20 and 10, that means the third day you're going to let it go to even as much as 5 paisa. What difference does it make? Let it go to 5 paisa. And let there be buyers at the 5 paisa if they have to come and buy it. So that would actually give any relief and remove all these, whatever happened at Castex. And I don't know who was involved in doing that. But it was a very, very interesting way that they use mathematics to figure it out. But you won't have that problem here. After 3 days, your circuits are unlimited. So the price could go anywhere on the upside and anywhere on the downside as well. So you'd actually end up with no, this thing. So I would say having no circuit day after 3 circuit days is a perfectly easy way to do it. Another way to think about it is what Pakistan did. Let people panic. Let them panic and sell whatever they have to, because eventually you're going to find buyers. And that buyers of good stocks will always be there. Bad stocks will go to zero. So what? I think most stocks end up being decent or good or correct or something like that. But that's the idea.
I think when we had discussed this, the point was, then won't people, create uncertainty and fear and bully a stock down to zero, and then they only buy it and then ride the way back up? Or similarly, they own it and so they'll create fake news, push it up and then sell it at the top. I mean, isn't this a problem that you have?
It might be, but you could do that with circuits as well. Just instead of taking 1 day, it takes 15 days, but it's the same. In fact, in 15 days, you attracted more suckers, right? You actually said, listen, the stock is going up on circuits, go in there, try and get a short in, and then you attracted the sucker all the way to the top, and then you can dump it at the top, and boom, you're gone. That's pretty much how crypto works nowadays, with these shit coins that are manipulated up and down by everybody. They call it rug pulls. We just call it market manipulation. So the idea over here is, that is the thing.
Fair. I think, as I'm thinking about it, in crypto, there are no, circuits whatsoever. Can't say it's an example of a great and wonderful functioning market, but I mean, I think there's something to be gained from that. I think we had all read some anecdotes of some zinc trading case where people used the lack of circuits, the presence of circuits to...
Oh yeah, there was the presence of circuits, but then what they did was they did a complete trading halt on it because there was one trader in Hong Kong or in China who was such a big part of the market. He said, listen, I just don't have the money if these prices keep going up. I simply don't have the ability to supply the zinc that at this price and all that stuff. So they halted the market so that the price wouldn't go up. There was no price for a while. And then only when the global market liquidity kind of cooled down is when they reintroduced this zinc trading thing, and then slowly it came around. Zinc or one of those products that would have been, that company, the Chinese company would have been bankrupt had it been forced to kind of deliver on those. But they actually halted it so that it could.
So sometimes you can also just halt markets.
And you have a. I mean, it's like when you have the gold, you make the rules, right? So if it was a small trader, they'd never halt the market. If it's a big enough trader, they halt the market and somehow make sure that the person is profitable before they reopen it again.
So on that note, I mean, all of these are just interesting constructs, but let's see. Would you wager a guess that circuits will still be around in India in 3 or 5 years?
I mean, I could say what I want. I don't think the powers that be will take this in any meaningful way. But I think I do hope at least we'll change the nature of circuits to say, listen, on day 3 of circuits, we're going to give you a free for all. It's like that free hit after a no ball, right? You won't get out on that thing. So go and take a free hit on day 4 if you guys keep hitting circuits. I hope that happens. I think that's the most meaningful thing that can be done. It may be disruptive for a few players, but how does it matter? Your price discovery is wrong with a circuit. It hurts mutual funds who own the stock. Why would you allow a circuit to continue indefinitely? So instead, create room for actual price discovery, which is what I hope will happen. Let's hope that things change and prices will remain volatile forever, regardless of how much markets improve. All we know is that if you make it such that people know, I think liquidity will find its way to protect downsides.
On that optimistic note, let's end today's podcast.
Thank you so much.
Thanks everyone for listening. If you have feedback or ideas for new episodes, then please do send them over to podcast@capitalmind.in. To learn more about us, go visit our website, capitalmind.in. Till next time.